All right. Here's the value add business plan, guys. This is when I say value add, this is why apartment buildings are freaking magic, okay? Because it works on single family homes too. You can make it work on small assets, but everything gets multiplied on bigger multifamily, okay? So there's the market right there. That's the Fayetteville market. Again, this is called a scatter chart. You guys can get them and generate them on your own. They're really, really powerful tools to see what it is you're dealing with, okay? So this blue line is the average of all those little blue dots. You guys with me so far? Okay. That's the average of all those little blue dots, okay? That little red dot right there is Douglas Square on Hope Mills, okay? That's the apartment building we bought, okay? Our goal was to get it to there, okay? To bring it up to the blue line, bring it up to the market. Okay, not a big deal. You know, that's about a $125 rent bump, okay? So this is a visual representation of opportunity.
We just worked out a contract with Spectrum Cable, and where they are now the exclusive provider of cable and internet services to this property. So the tenants get a high-speed internet cable package that includes HBO for a nice low price, and we get a cut, basically. So because the tenants will pay a certain amount, we pay a certain amount, and there's a little bit of a gap in between. So we get to make a little bit of money per door, right? And also, Spectrum paid for the right. So we got a check from Spectrum when we signed the contract. So we got a nice chunk of money up front, and now we get a monthly recurring revenue stream just by having Spectrum be the exclusive provider. So we just went through an entire renovation project where in every single unit, 198 units, we installed a Spectrum box. So now we're all cable ready, set up so that you can just plug it in, and all of our units are now wired for Spectrum. So this is actually going to be our laundry room. When we purchased the property, it was an inoperable room. It had been a laundry room in the past, but previous ownership was not using it that way. So we've been using it for storage for a while. So now we've got a crew that came in, cleared it out. They patched the ceiling. They're painting the walls, fixing the windows. We're going to put an air conditioning in here. We just got some appliances delivered, and we're going to basically clean it up. And within the next 2 weeks, this will be a fully functioning laundry room for our tenants. They can go into our leasing office and basically prepay, essentially like a prepaid debit card for laundry credits, and then they can come and swipe their card here and use it. So that prevents people from outside, people that are not our tenants, from actually coming in and using our units. It's something that allows us to control who is using the units, because we're paying the utilities for this unit. We're paying for the water, we're paying for the electric. So it's a service that we're offering to our tenants, and they are paying then to use the washer and dryer through the card, but we don't want it to be free reign where anyone can come in and this is not a public laundromat, this is a laundry facility for use by our tenants. And so we've set up some controls to make sure that it is our tenants that are using it.
Okay, somebody got a calculator? Where's a brain? He's a brain. Okay, cool. Give me a calculator, okay? All right, if I'm able to achieve we'll go $110 rent bump, okay? On all my units, times 198, okay? And I do that over a 2-year period because I'm able to increase rents, and I renovate the apartments, and I do all kinds of cool stuff for the complex, and I'll show you guys what we did, okay? I do all that. So $110 times 198. What do we got? How much per month? $21.78. Yeah, times 12 months. No. You got to break it to a year. $261, $360 per year. Okay, now, here's the real game you guys play, okay? What am I going to do now? I'm going to what? Thank you. Why am I doing that? Why am I? What? Because I'm going to do what? I'm either going to sell it or I'm going to refinance it, right? So so these guys already got it, right? So here's for those of you guys that didn't catch up with these two brains over here. For my hunters, my hammers, and my right, for everybody and the money people, here's the way you play the game. Okay, we just increased our net operating income by what? $260,000 a year. Okay, did I increase my expenses when I did that? No, except for my property management fee, right? But it's like that much, right? Okay.
But we thought about doing our own short-term rental model, but we actually had somebody who's an investor in this complex, entrepreneur-minded, wanted to try out subletting a unit and putting it on short-term rental sites. So they're renting this from us at our base rate for what we rent a 2-bedroom, 2-bath townhome for. They're paying us that, and then they're going to put it on the market, mark it up. They're going to furnish it. They're going to handle the interaction between the customers that want short-term rentals and do all that brokerage, pay their brokerage fees for that, and then we're going to get regular stable rent. Now, what it enables us to do is, number one, continue to add more tenancy to the complex and stabilize our property, but it also enables us to test out to see how this goes. So if this goes without us taking any risk, because we've got this investor under contract under a personal guarantee that they're going to pay the rent here for over a year's time, right? If they don't get that many tenants, if it doesn't work out, they still have a contract with us to pay us regular rent. So we get a no-risk experiment to see if it works. Now, if it flies off the handle, which I think it's gonna, then they can go and do 10 more of them here, or we can do 10 more of them, right? But we can decide if it works, and if it doesn't work out, we won't do any more. But if it works out for them, then we'll probably try and do a bunch more.
So we're well over halfway done with our renovations, and we still have about another 50 units to go. So we'll end up somewhere around 50 unrenovated, and then the rest, the other 150, will be some version of classic or deluxe. It is possible to renovate all the units, but that's not our business plan. So we're actually planning to leave a significant amount of units unrenovated so that it helps when we go to sell the property. Because the next buyer is also going to look for some what we call meat on the bone, where they're going to want some additional value add opportunity. So if we've done all the renovations, then it's really a turnkey property and it's going to be less attractive to potential buyers. But if we still have about a quarter of the units that are not renovated, we've proven out the new higher rents, we've proven out the model and the level of renovations, then that still allows someone to come in, renovate the last quarter of the units, and still capture what everyone looks for as a value add opportunity. Every buyer is different, but most buyers now are looking for a value add opportunity because of the way that cap rates are and the prices of apartments. The way that people are making their money is through renovating units and increasing rents. So that's what we call value add. And so that's what we want to be able to offer to the next buyer as well, so that there's more incentive, which means our property should sell a little bit quicker. Maybe it won't get quite as high dollar as if we had renovated all the units, but there's other benefits to not spending that money to renovate and being able to sell it quicker.
So apartment buildings are valued not because of what the building next door sold for, but by they're viewed as a little business. It's like buying a little company. And companies are valued off of how much money they make, right? So apartment buildings are valued off of something called cap rate. And you take the income that they make, the NOI, the net operating income, and you divide it by the cap rate, okay? So around here, the cap rate's somewhere between 7 to 7.5%, okay? Right? Give or take. Now, we underwrote it at 8 because we thought rates were going to go up. They've not. So we think we might be able to get 7 to 7.5 for it on a refi, okay? So get your calculator, one of you two. Okay, my two brains over here. Divide it by, give me a 7.5 cap, 0.75, 0.075.
3,484,660.
That's how much value we added to the apartment building by raising the rents $110. What's the number again?
3,484,666.67.
Freaking awesome, right? I know, right? Yeah, right? We haven't done it yet. We're on the way there, right?